Hi, everyone, and welcome to another episode of Valley of Depth. I'm your host, Mo Islam. My guest this week is Mark Boggett, CEO of Seraphim Space and one of the earliest dedicated investors in the space economy. Mark and I discuss where the commercial space market stands today, what has changed over the last decade, and why he believes the real value creation is only just beginning. We also get into how Seraphim was built, how he thinks about backing founders and navigating competition, the emergence of European neoprimes, and the sectors he believes are best positioned for the next wave of growth. Let's get started. So, Mark, if you zoom out today, what inning do you believe are we in the commercial space economy, in sort of the growth and development of the commercial space economy? Where are we right now?
So we are in the early mid-innings. So we're...
Okay. I guess I'm also using a baseball analogy from someone who's from the UK.
Right. Yeah, well, I guess I was using a cricket analogy to send that back to you.
Yeah.
So look, we're at what we are in is the first phase of the new space infrastructure. So I think that what we've seen the infrastructure is largely built out in SATCOM, but it's still nascent in Earth observation. But crucially, the value creation of this infrastructure is still at the very beginning, and it's only just beginning to compound.
And how long have you been investing in this industry?
So I've been focused on space for 12 years and investing for the last 10.
Okay, and then in that time period, what's the biggest change and shift that you've seen in the industry?
Well,
I know that's a very
so
there's a lot of ways you can go with that question.
So the first thing is that I now have more confidence when I'm investing into an early stage company that the $200, $300, $400, $500 million that company needs to succeed is going to be available. 10 years ago, when I was writing early checks into ISI and companies like AST Space Mobile, I had no idea that the money was going to be there from the other sources that were essential for that company to succeed were actually going to be available. So that's the biggest thing. And now I think that pendulum has really swung, so that we're now really confidently making investments into company where can it raise $200 or $300 million in the future to deliver against this? That's much less of a consideration now.
Well, tell me a little bit about how you kind of got into this industry, because you mentioned 12 years, but investing for 10. What prompted you to start taking these early bets in, this within the space industry? Like, what did you see, and why did you want to be so focused in your investment style?
Yeah, so I'd spent the previous 10 years as a deep tech investor, investing very broadly in frontier technologies. Really from life sciences right the way through to AI, 3D printing, new materials. So I've always been on that side of the investment. And what was sort of increasingly apparent to me was that there's just a massive advantage with becoming a thematic specialist. And when the time came to set up my own firm, and the reason that happened was the firm that I was working for started transitioning more to private equity away from venture. And they really wanted to sort of move away from, home run returns through a technology. They'd rather get, consistent 3X. And that sort of, really wasn't my area of interest. So I myself and two of the guys I was working with, Rob and James, so we'd been working together since 2006, decided to actually go and establish Seraphim and focus it. So because I had a 12-month period of transition, I actually had a lot of time to really think about this carefully. And actually, we were actually starting off with an AI fund, because AI was one of the areas that we'd had good success in the past. And, we were really, really comfortable with investing into. And but we had the time to really go and look more broadly and really be thoughtful about how we were going to do this. And space kept on coming up as an area of interest. And we were watching what was happening with SpaceX at the time. They weren't yet sort of returning rockets. The reusability element wasn't there. the Skybox was bought by Google around that sort of time. That was really interesting to see how a business that was sort of working on shoebox size satellites could quickly command $500 million enterprise value, and that was really attractive. So it was really really thoughtful an analytical approach to the market that made us convinced that space was actually going to go through a multi-decade transition, a disruption, effectively embracing the technology solutions from other markets where space had fallen behind on really Moore's law of other markets. So we became convinced of that, and that's when I went then to speak to the leaders of other space companies to test my thesis. So I'm probably going into too much detail here, but actually there's an interesting story here, Mo. So let me, if you indulge me a second. So what basically happened was I was introduced to the CEOs of 11 of the world's largest space companies to go and talk about this new fund for space that I was setting up. And I went and met all of them.
And what year was this?
This would have been in 2014.
Okay.
And, so I went to meet the CEO of Airbus and Inmarsat and SES and Telespazio and Teledyne and a whole range of other companies. And I was introduced at the CEO level and went and sort of explained why I was setting up this fund and that it was effectively about identifying new innovation, new business models, and why they should be interested because their market was going to go through a period of disruption. And 6 of the 11 CEOs that I spoke to agreed with me and agreed to invest into the fund. So it was actually the willingness of the industry to support my fund that really gave me the conviction to do the fund, because part of the issue was when we were looking to set up this fund, nobody else had set up a fund in this area. And that was actually a big problem because we were like, well, why are we doing this? If nobody else is doing it, why are we doing it? So the very fact that I was getting the support from all of those big space companies, and it sort of also addressed our sort of imposter syndrome of not coming from the space industry. Therefore, how can we go and set up this fund and make those investments? By being able to use the business units of those, 6 major multinational, multi-billion-dollar turnover space companies, that really gave us the confidence that we were going to really be able to, make a great job of being the first space fund. So that's really where it all came about.
No, that's a fascinating kind of origin story. What were some of the early pushback from prospective LPs? Like maybe LPs that eventually invested in your fund, or maybe they just passed on your fund at the time. Like what were common items that you heard when you were raising?
Well, space is a black hole, really, was the main sort of theme. There'd been many investors that we were speaking with that had invested, in the original sort of SATCOM businesses, the Iridiums and so on, that, failed to deliver against the promise. So really, there was a little appreciation of why new space was different to old space and why a new space approach was actually going to win out. So that was really the biggest problem, that folks, first of all, just didn't believe it was different this time round. This is a capitally intensive, long-term industry. And we were trying to say, well, it's still a long-term industry, but it's not so capitally intensive. The math works better now with the new space economics than it does with the old space economics. And that was a real challenge. One of the biggest investors that we were able to convince on that was the British Business Bank, who were a major LP in our first fund. But they were more sort of relying on what I'd done in the past rather than really buying into this. But they recognised because space has always been an important industry in the UK, and the amount of industry support that I'd managed to garner for this first fund was really convincing. And I think ultimately that was the thing that allowed the early investors to sort of take that leap of faith. Why are all of these leaders from the traditional space industry putting their money into this fund? We're telling them that there's a disruption coming. They obviously believe that to be true. And if that is true, there's clearly some money to be made on it. So one of the things that this really focused in our mind was that we had to take bets in the industry that were effectively going to allow us to be able to return money sooner rather than later. We're investing 10-year money from LPs that are skeptical about how long it's going to take for them to receive that money back. So from day one, we were like, right, let's focus our attention in investing into companies that can perhaps provide us with the return within that 5 year, within the 10-year period.
Well, so I'm curious how you did think about that, because if you're talking about 2014, 2015 timeframe, right? At that point, SpaceX had been around for, I think 2002 is when they were when the company launched. So like call it 13 years. I need to double check that, but effectively what I'm trying to say is by then the arguably the most innovative and fastest growing new space company at the time was SpaceX, and it still wasn't public, and I don't think it looked like it was anywhere near going public, obviously at that time, or that wasn't even a discussion point. So I'm curious, like if I'm an LP, just to play devil's advocate, if I'm an LP in 2014 and you're pitching me liquidity effectively in under 10 years, how do you tell that story when like the best company in the space was still not public even after a decade?
Yeah, well, with great difficulty. This is the reason why it took us just shy of 2 years to raise the initial $90 million for our first fund. So, it's a leap of faith by the LPs that backed us there. For those who are prepared to listen to the story several times over and buy into this, because this was all about the promise of what a SpaceX could deliver in terms of lower costs, because they weren't being realized at that time. It was a direction of travel rather than they weren't commercially operational. They weren't successfully landing the reusable elements of the rockets. So all of that was sort of still taken on faith. So investors who are investing in LP seed and A series funds, go in recognizing that 10 years is always going to be 12, perhaps 15. Many of the investors that invested into that first fund had invested into my previous funds. So they were investing into the manager. They're backing the jockey rather than the horse. Whilst I think people would have just called us crazy if it wasn't for the massive amount of backing that we had from the industry, that were really, underlining, the truth of the potential of this disruption.
So on that very first fund, have you started returning capital on that first fund? How are the investors and LPs feeling about that one? Since that was
they are very happy. We've returned all of the funds closed down. We've returned all of the capital, and investors made a 3x return net.
Great. Congratulations on that. So talk to me about your strategy then. Like, so on that first fund versus what you're doing today, maybe give me a little scope of like how Seraphim, and I know, by the way, I know you've recently gone through a rebrand and I'm sorry?
We haven't.
Generation Space. What is
so this was
tell me a little bit about sort of the architecture of the entire firm, because I know you have a number of different things going on, the accelerator program, the private funds, the public fund. Give me a kind of overview of all that.
Sure, yeah. So there's three elements to the overall Seraphim business. We have an accelerator program, we have venture funds, we have growth funds. All of them invested into space, all of them globally focused, managed out of our UK team, but with satellite offices in San Francisco and Berlin. About 20 people full-time in the organization. We've got sort of a lot more sort of part-time that are involved as well. So we receive a giant global deal flow. We triage that between the three different parts of the business. So the stuff that's going into the accelerator program is typically coming out of university spinouts, teams out of different large companies like SpaceX or like some of the primes. So this is sort of pre-seed. In fact, pre-establishment in many cases. folks who are coming onto the program haven't yet set up the company, and many companies actually set themselves up and spend the first few months of existence in one of our meeting rooms after they've completed the program. So it's a 3-month program. We take 10 companies onto each of those cohorts, and they're very global. We've had 36 different countries represented. And we help them with various facets of how they get themselves ready for the fundraise activity, and think about establishing a board, and think about accessing advisors, and all of this. And we also introduce them to our corporate partners who are very interested in their new innovation, new business models, new technology, new ideas. And then we sort of release those companies, into the market. We introduce them to our VC friends around the world who syndicate and invest. So the companies that have gone through the 15 cohorts we've done of that today have raised $1.1 billion post going through that program.
And then just to be clear, is Generation the accelerator program?
Yes. So Generation Space is effectively what we called the accelerator program, and what we call our podcast that we do as well. We've then got our venture funds, and they will invest into the companies that are coming through the accelerator program, and they will invest outside of that. We've recently closed our most recent fund, where we've not done the final announcement yet, but we're over our $100 million target, and we've been investing into that fund. We've already invested into 17 companies in that portfolio. And then we've got our that's a UK fund that invests globally. Right now, more than half are US. It's more like sort of 60% US, the rest sort of Europe. Then we've got our public listed fund, which is listed on the London stock market. And that is another global fund that invests in B, C, D, and E. We've got 26 companies in that portfolio. Last year, they raised $2 billion in equity funding. The top 10 companies out of those 26 have last year, their revenues grew at just below 80% on average, and 86% by value will be profitable in 2026. So we've got 2 that are profitable already, and 86% by value will be profitable this year. So there's been a massive growth spurt throughout that portfolio. That fund is the number one performing fund on the London stock market this year, and is really sort of firing on all cylinders. So taking a step back, we've invested into 46 companies since we established Seraphim over the last 10 years. We've had 9 unicorns, we've had 5 IPOs, we've had just 4 failures. So less than 10% failure, and more than 20% unicorn success.
Well, first and foremost, congratulations. Those are impressive numbers. I do have to ask, what is the strategy of the firm? If you had to take a step back and describe it in 2 sentences, how do you think about the industry, and what type of founders are you backing?
Sure. So this is one for the LPs, which we normally start off by saying what we're not. So LPs conjure up an idea of what a space fund is, and we kind of don't do any of the things that they expect us to do. So we don't invest in launch, we don't invest in space travel, we don't invest in anything to do with the moon or anything to do with Mars. So those are the 4 areas that we don't invest into. Okay.
So you've never invested in a company that had that as a core strategy: launch, space travel, the moon, or Mars.
Correct. Yes.
Interesting. Okay, we'll touch on that later. But
so then what do we invest into? So again, this is the sort of LP answer, and then which is that we're trying to invest into companies that can provide a return within the 10-year window of the money that we've taken. So what that leads us to doing is investing into companies that are specifically focused on Earth providing space providing services back to Earth, where there is a genuine market, where there is a budget, there is a requirement by a customer to buy that product, and that already exists. So that really lends it to investing in sort of digital infrastructure and everything that sort of provides back to Earth. That's where we've done most of our investment, and we're now just starting to invest into infrastructure-based plays over the last handful of years, effectively that are building infrastructure for Earth. Cell towers in space, I've alluded to the fact that we invested in AST early, but things like manufacturing capabilities for the space environment, we're an investor in Voyager, and then it goes through to anything that's sort of infrastructure providing, but effectively where the customer is an Earth-based traditional market that has a budget today. So that's really how we sort of where we focused. And then to answer your question, how would I say it in a few words? Really, what we're really looking to invest into, what the sweet spot is a vertically integrated satellite constellation. That's what we want to invest into every day of the week. And how has that strategy changed over the last 10 years? Amazingly, it hasn't changed at all.
Mm. So when you think about the last 10 years and the evolution of the investment sort of community around the space industry, clearly it's become much more in vogue, right? Space is like now space defense, like these are areas that a lot of funds, quite frankly, are completely pivoting to. So now you have very large, well-resourced funds in these arenas. How do you think about how your sort of competitive moat, or like how do you think about like, when you find a company that you really like that meets your criteria, but you're sitting across the table theoretically against a large fund, well-resourced, and is maybe cost agnostic and wants to get a deal done with a fancy term sheet. Like, how do you think about that, like dynamic? How do you win that deal? And tell me a little bit about how the evolution of the competition, like over the last 10 years.
So there's quite a lot to unpack there. So we are more price sensitive than a much larger fund might be. So there are scenarios where we just can't make the numbers work on the valuation, and we have to just walk away. We are a financial first investor. We're not doing this because we love the space industry. We're doing it to make money. So if it just as an organization, there's just a sort of choking point when we get to a certain valuation that we just can't deal with. So we're just sort of walking away from deals where that is the challenge. There is only one example of a situation where we've competitively not been able to get into a round. I mean, space is a team sport. Yeah. Even the biggest funds are not writing 100% of the round for whichever company it is in whichever round. All of these players want to invest alongside other investors, provided that they can bring something to the table. And I think that we've built a reputation over time to demonstrate that we bring something to the table. We join the boards of most of the companies that we invest into, and we are a very hands-on investor. So, one of the realities of the world of investing into early-stage businesses is that the founders that you back on day one aren't necessarily the right parties to take that business right the way through to, later stage growth. And if some investors don't have the stomach to get involved with the transitions, and we are more than happy to do that. So that we can point at, and that's just part of our reputation in the market as being sort of, if we're in the room, we are actively engaged. We are not a passive investor. So that has really opened up the doors to be, to have the opportunity to invest into most companies that we've wanted to invest into.
Yeah. Well, talk to me about this piece on the founder, because, most investors want to, position themselves as, founder friendly. We let the founder do their thing. Where do you think that, and we don't have to talk about specific situations, but what are elements that you've identified where, you have a founder in the early stages, it makes a ton of sense. And then at some point, it's like cracks appear in the business or the leadership style where you start to say to yourself, okay, like this is really the profile that we need at this point of the company's like life cycle.
Yeah, it's different in every case, and we are founder friendly. We do want to back people who scale all the way through to success, and we've got loads of examples to demonstrate that. If it's not broken, don't try and fix it. What is normally required for us, where it becomes through necessity. It's typically a company that hasn't achieved the things that it set out to do over the time frame that it set out that match against the money that it's raised. So, so they're then back to their existing shareholders to raise more money because things haven't worked out. And look, I spent my career investing in early stage. It rarely works out. But the way that the management team and founders behave in that period will sort of demonstrate to you, what they're likely to be next. This is one of the great advantages of building conviction over time in the capabilities of the management team, and how they respond to the ups and downs of running their business is really insightful. So we've got sort of all the history of all of the teams that we've backed and how they behave in sort of adverse situations, and how they go about doing that. And really, the sort of key thing that really sort of indicates whether these guys are going to be successful or not is whether they're prepared to listen to anybody. And that is one of the things that we're really sort of really testing for when we're investing into companies. Are these individuals that are prepared to sort of listen to members of their board, listen to investors, listen to the advice of non-execs, listen to the advice of their own senior management team, or not? And this ability to not be told what to do, but to take on board advice and respond to it is a critical success factor. So what we will often find as we are learning through the process of being invested into a company is teams and founders that just refuse to listen. So that will either sort of lead to us not wanting to participate in subsequent rounds where things have gone wrong, or us wanting to, first of all, sort of supplement the management team. What we really require here is a new COO, or just some more experience being brought into the team. That's phase one of whatever we would try and do. And then if that doesn't work, then it's a sort of a grown-up conversation, which normally sort of aligns with the next funding round in circumstances where companies haven't quite hit or nowhere near hit what they were expecting to do, where we're like, right, okay, well, is this company better served with at this point with the change of leadership, and what is the appropriate thing to do, and it's different in every case. But the thing is that I've spent so long investing in early stage that you're either an investor that's prepared to deal with that, or one that's not. So we are prepared to deal with it, which means that we will invest into companies, with potentially some concerns about the team and about how we need to sort of help them transition over time. So nine times out of 10, that all works out, and what 1 in 10 it doesn't. We're prepared to do what's necessary, working with other shareholders, working with the company itself. You can't force this on any company, so it has to be done, in a collaborative way. And that we're investing other people's money. We basically, do everything that's necessary to give these companies at least a couple of shots at getting it right. We don't really give a sort of third shot.
Is there a company that you passed on that you wish you hadn't? Give me an example. I'm sure there's a few out
Of
there.
course, there's plenty out there. Astranis is probably one that we regret, and we were in process on their A series, and we timed out. I can't quite remember, but I think they brought it forward by a week or two. We just couldn't hit it, and off they've gone. And I love the fact that they're just disruptor in the geo market. Because they are the disruptor in the geo market, in my view, it's sad that we didn't get exposed to that one.
So I want to talk about a company in your portfolio, ISI, and it's a big position for you. I also understand that it's a large part of your listed funds NAV or NAV. And I also want to be mindful that it is a public position. So obviously it's part of the public fund, I should say. So tell me if I'm asking any questions that are that you can't answer. But most recently, what I'll say is the company did in a press release publicly say that they would be effectively doubling their revenue this year from 250 million euros to 500 million euros and then €1 billion next year. What is going on with that business? I'm very curious because you look at Planet Labs, which is another publicly traded company. They did I think their trailing 12-month revenue was I looked it up right before this call, around 280 million. And I think their fiscal year 25 was around 250 million, growing at a very nice clip. And that growth has been accelerating over the last few years. But that ISI growth is something that is really sticks out to me. And I'm curious, how much visibility you have into what the company's doing right now in the strategy.
Well, we sit on the board and have done since 2018. So
there you go.
We've got a reasonable view. One of the other stats that is in the public domain, so I can say this, that's pertinent to your question, is also the fact that last year, on 250 million of revenue, they did 100 million of EBITDA. So that is wow. 100 million of EBITDA on 250 million of revenue. So just before I go into to talk about that, let me just take a step back. You talked about this being, one of our larger holdings. One of our strategies at Seraphim is that when we have built conviction in a management team, we will take the opportunity to double down. So this is one of our double down companies. So we consciously take 2 units of investment into companies that we believe are going to be able to provide us with an exceptional return, where we've built conviction because the management have demonstrated them to be a particular type of management team. So there's several across our portfolio. ISI is one of them. This is the reason why we've got such a big stake in the company itself, but also why it's now, because it's grown so much, why it's such a big stake of our own fund. So to go back to the point that I was first of all saying about the profitability. So this is really one of the first examples of where we can say to the LPs and those interested in the market, this is new space working. New space is about ultra low cost infrastructure that creates a unique data set that is the value of that business going forwards. And what this company's been able to demonstrate by that massive level of profitability is that this is a great example of what new space is all about, which is just fantastic. So that's point number one. Point number two about ISI, which is really a European poster child of what's going on, but it's also a really interesting reflection of what's happening around defence in Europe. So during the course of 2025, from April onwards, ISI are very open about the contracts that they win and really publicise them. We have other portfolio companies that keep these contract wins very close to the chest, but ISI put them out there with plenty of information each time they do that. So what's happened every month since about April of 2025 is that ISI have announced a new customer that is effectively a European defence organisation. Let me think of the list. You've got some. I'll probably get this wrong, but it's Poland and Denmark, Greece, Netherlands, Portugal, Finland, and Germany. So once each month, those announcements have been coming through that they've been winning sizable contracts with each of these government defence organisations. And the one that was announced in December with the German defence government defence organisation was a 1.7 billion euro contract. So some of those other contracts have also been identified as contracts valued in hundreds of millions of dollars. What that really sort of demonstrates is what's going on in Europe at the sovereign government level, which is that traditional procurement processes have been completely swept away, and that these governments are willing to identify a technology leader and quickly align themselves with it, and make considerable a budget available to that company, and they're buying a sovereign capability that they are then effectively going to operate and rely on themselves. So that's putting a lot of faith in a startup, unprofitable startup that is very different to the way that they're traditionally engaged with the prime community. So I'll just pause there. I can see you're desperate to say something there, Mo.
Yeah, no, I want to, there's a lot of ways to go through this, but I do want to ask the sort of seemingly obvious question, which is like, so you have a company that you've mentioned, is now getting a lot of attention from all the European governments, and in almost a coordinated fashion, getting in these contracts on a very regular basis. Is this an exception, or is it a new way of doing business with the government in Europe? Because Europe obviously historically has been a place where the investment community, especially on the American investment community, has largely ignored. European companies have struggled to raise capital within Europe, at least the large amounts of capital we're seeing in the US.
Correct.
So maybe let's take a moment. I'd love to get your thoughts on like, what do you see happening in Europe? And is ICEYE a reflection of a kind of a trend, or is it just as specific to that company?
No, I don't believe it's specific to the company. I believe it is a trend. What this is a nice window into is the sort of changing mindset of governments and their procurement. And what is really evident is that they want to operate quickly. Speed is of essence. And really, to understand the sort of driver behind that, you really have to take a step back and try and understand why this is happening and what the drivers are. So I'm sure all your listeners are aware of this, but really ultimately, Europe has relied on the US to finance 2/3 of NATO's budget for the last 60 years, and the space element of that, Europe has really largely just completely relied on the US. So in March and April last year, when it became obvious, when it was made clear, particularly by the US switching off support for the Ukraine, was that Europe had to stand on its own 2 feet. The reality was, and what folks didn't really recognise was that they just didn't have any of this capability at all. What launch exists, what ISR existed, what SATCOMs existed. These are really important elements that these nations need to be able to protect themselves and protect each other, and they simply just don't exist. So they have needed to go from sort of zero to some adequate level of capability as quickly as they possibly can do. So what we're seeing with ICEYE is the first of a series of the use of budget in order to access capability that they perceive that they need urgently. So So in doing this, every country has done it. This is one of the challenges with operating in Europe. You've got 27 countries that, whilst they're bound together under the EU, each of them from a sovereign capability, how they run their own. There isn't a single defence unit across Europe. It's individual countries that contribute to NATO, but they do that in a sovereign way. So everything is different in every country. All of their processes, all of their procedures, everything is different. So what we're seeing happening at speed is the complete change in that. And there are test cases that sort of are proving this, and ISI is one of those test cases. I've got another sort of interesting data point that I think sort of also sums this up quite well, which relates here to the UK. So what the UK have done is that they've rapidly appointed an individual that is responsible for all of procurement across Army, Navy, Air Force, Space Force into a new role called the National Armaments Director. And they've rapidly gone out to identify someone to do this role. And the person that they've chosen to do that is a guy called Rupert Pearce, who's the ex-CEO of Inmarsat, UK's largest space company, which he left about 3 or 4 years ago. And then he joined the venture industry and became an investor in technology businesses, which he's done for the last X number of years. So what the UK have selected for this most important person to change procurement is, one, a space guy, and two, a guy that is really comfortable around emerging technologies. And I think that really paints the picture for the mindset for change that's required in Europe. And I think that ISI is the great example of this working in practice.
So if you're looking out your next run, your subsequent dollar, like, how would you, let's just say you're $100 to invest, what percentage is going into US and what percentage is going into Europe over the next 5 years?
Well, that's a really good question. And this is the reason why we have always been a global fund. And that has been a great challenge to us, because investors don't think globally, they think regionally. So American investors want to invest in America, European investors want to invest in Europe. And we've had to turn down a huge amount of capital over the last decade because it came with strings that would force us into being only an investor in Europe or only an investor in America. We've wanted to keep our options open, and we remain in that exact same position right now. So all of our funds are global. So we will continue investing globally. So the macroeconomic effects are changing on a monthly basis, as we're all aware. But what is clear is that the US is going to continue to be a powerhouse in this market, and that in areas like defence, there is significantly less friction to invest into a company that sort of wins that contract with the DOW than there is in Europe that wins that contract with 17 of the 27 EU players out there. It's just harder to do that. So where's that dollar going to go, or where's that $100 going to go over the next year? So I'm sitting on the fence here, but I actually believe that this is true. I think it's 50-50. I think that the opportunity in the US is really exceptional and remains so. I think that US companies are still going to be successful internationally, and there's a significant period of time where, frankly, there still isn't the European companies to provide the necessary services that Europe requires. And there's still significant opportunity for US firms to fill that gap for 5 to 10 years. So, but there is and I think ISI really portrays this, a massive and immediate demand in Europe. And what I see as the sort of outcome here is the creation of neoprimes. And I would argue that ISI is now a neoprime. And what I mean by a neo-prime is a company that's really been anointed by governments that, whilst this is a startup, they've proven that they can deliver on time, can deliver, technically competently. They can deliver against the sort of low-cost promise that they've done. We've seen that operating, and we're now going to put our faith in them being able to replicate that at a larger scale. So our focus is in trying to identify and invest into those neo primes, because I think they get that confidence in these government customers, and they'll win contracts that really they shouldn't perhaps win, but the government has got confidence in them as an organisation. So I'm expecting there to be a decent number of European neo primes that are created during the course of the next 5 years. So I want to make sure I'm invested in all of them.
So let me ask a slightly different question then. So like, I think I don't think you would disagree with this, but tell me if you do, which is that valuations in Europe in general are just more reasonable and more fundamentally aligned. How much more fundamentally aligned are they? Like, if you were to say, when you look at it, when you look at your average American space company today versus your average European space company, how much tougher is it to wrap your head around the American valuation versus like the European valuation? Like, what is that? I mean, and you feel free to use numbers, but I'm really asking more of almost like a qualitative than a quantitative question.
Yeah. So I can give a really clear answer to that challenging question. That valuation is determined by the size of the round, and typically, take an A series. Typically, the round would be taking about 25% of the round of the ownership of the company at that stage. And typically in the US, the round sizes are materially larger than they are in Europe, and that is becoming more even at sort of seed and Series A, but still very much is a big difference when you get to B, C, D, E, and so on. But really, the sort of typical scenario is that the American companies are raising a larger round and are therefore, by necessity, doing that at a larger valuation. So that's one of the things that we sort of looking when we're sort of comparing, and we are regularly looking at two companies. Here's the European and here's the American play. And historically, we would have said, which one of those are we going to back? And now we live in a world where we are quite happy to back both.
So when you look across all the different segments of the market right now within space, where are we overbuilt? Like, where are we? When you see a company hit your, come across your desk, you're like, oh, not another one of these. What are some areas where you feel like we are overbuilt and we just don't need another company?
Well, I've already explained that we don't invest in launch.
Sure.
So, we see a lot of launch companies.
But that being said, I would argue launch, is it overbuilt or is it not? I don't know. I think that's a question to ask. Like, when you have SpaceX wanting to put up 1 million satellites, or, according to their filing with the FCC, and that's like maybe Starship capacity for the next however many years, and you don't have, then you have, Neutron, Electron, which is a very small rocket compared to what the market needs, and all these other rockets that are not still really operational. But that's a whole different conversation, so we can set that aside. But that's what really, I mean, overbuilt in capability and capacity. Not so much like how many companies you see in a segment. It's just more like the actual infrastructure side of it.
Yeah, no, I think we're still, your first question was, where are we on the growth curve? And my answer was that we're still right at the beginning. So, there are areas where, well, just to finish off my sort of comment on launches, that I've sort of stopped counting. I think I stopped counting at 200. You'll probably know better than me, Mo, how many launch companies are out there. Is it 400?
Well, launch companies that were once out there versus how many are still operational and alive, I mean, it's a fraction. I mean, that I don't know the exact number, but I do remember we used to quote something like a 200 number like a few years ago, and then that was sort of at the peak of the capital craze, coming out of sort of the low interest rate environment, which obviously all kind of came reversing over the last 5-6 years. But yeah, I mean, at one point it was something like that, like a couple hundred, startups, and now it's far, 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 far less. And I don't think anyone in their right mind is deciding to start a launch company right now.
We still see an awful lot of them.
Yeah.
So we still see an awful lot of them. You might be surprised. So yeah, so that would be the first area. But is there anywhere that is really really overdone? Well, do we need another optical constellation to take more pictures from space? I would argue that we don't. Do we need any more traditional geo players with their traditional geo satellite? Probably not. But I think most of the other areas, I think that there is still significant growth. If you look at the sort of supply chain, the component elements of that, there's still loads of components that have got a year lead time. So there's lots of opportunities remaining to sort of invest and make that more efficient. I think that the supply chain sort of regionalization is still a massive play. So I don't think that within the sort of component elements that we've seen sort of overinvestment. The constellations is the area that we consider to be our bread and butter. A lot of newer investors that come to the market, particularly space funds that are coming to the market, kind of overlook all of the constellations. We love a good constellation, and we continue to believe that we can invest in tens and tens and tens more of them. So please keep those coming. But that's an area where I think that certain players in the market would say, how many of these sort of constellation plays do we need? How many SAR companies do we really need? I think that we've still plenty of scope for growth on all of those. And then I think as we sort of get more into then the sort of downlink, this is which is what we sort of the term that we refer for sort of moving data from space back down to ground, all of the sort of ground station equipment and everything that goes with that. That's an area that I think has been massively underinvested in across the course of the last decade. It's growing in focus and is one of the as a category, faster growing categories, but it's coming from a very low base. So that's the sort of inverse of your question. I think that's one that where more focus is needed. And then you've really got the sort of data analytics companies that where there are not many good examples of great successful space analytic companies. So these are companies that are effectively using space data as the predominant elements of their data sets that they're then selling to customers. There are sort of limited examples of breakaway successes of companies that are effectively not owning satellites but using space data to provide a analytics-based service. That's the area where I think that money continues to pour into, but there's little evidence of that going well. I think that access to AI and just AI companies being able to rapidly compete around data analytics, I think is part of the challenge there. In fact, one of the things when we originally set up Seraphim, and if you were to sort of be interviewing me 11 years ago or 10 years ago and say, what proportion of the portfolio will be in sort of software-centric data analytic companies versus hardware companies, I probably would have said 80-20 in favor of the data analytics, and the reality is the reverse. So yeah, I think working through category by category, I think it's the sort of data analytics element where there's probably too many Me Too companies that have got a challenged long-term business model given everything that's going on, threats from other forms of analytical businesses.
So I want to spend these last few minutes here talking a bit about sort of what's coming next. And I know we've alluded to a few of these things, but I want to go back to something you mentioned early in the conversation, which is we don't like to invest in the moon and and Mars. Next month, hopefully, we will see. I mean, we're kind of knocking on the moon's doorstep now. With the Artemis mission and program, and you have two of the largest space companies, SpaceX and Blue Origin, who are very much interested in building the infrastructure for the moon and one day Mars. So I am kind of curious, like, how is I know you mentioned that we don't right now. Do you see that evolving? And is it because you don't see a viable economy on Moon and Mars, or not an investable business model? Like, tell me about what you think today versus how your firm will look at this over the next decade.
Yeah. So look, it's evolving as space is evolving. So as I mentioned, our sort of previous focus was really around the digital infrastructure that's being built around constellations, and we've evolved that into now also doing infrastructure, and it's all about sort of serving Earth. So the first answer to that really is that I truly believe that there's a multi-trillion-dollar market opportunity just in the data and the constellation businesses that we're investing into. So, and that is near term, real customers, real demand, and that is sort of upon us right now. So that just aligns with my sort of ethos as an investor, investing other people's money, wanting to return it within a reasonable time period, a great track record that I want to build upon of delivering against that promise. So we are not short of investment opportunities in lower risk environments that are directly aligned with everything that we've done in the past, where we've got lots to add and value add and relationships that we can bring. So it's a sort of risk reward element right now as to this is a giant opportunity that we're still at the very beginning of. Why do we need to go to the extreme of investing into newer markets right now? This is one of the benefits of the three parts to our business. So if you actually look at many of the businesses that are going through our accelerator, we don't distinguish between the different stages of growth of companies that go through our accelerator. So, for example, we've got companies like Virtus Solis that, are doing solar farms in space that, went through that program, 4 or 5 years ago. We really like to identify great businesses, great founders with, brilliant ideas, and we put them into our accelerator program. And that's a platform for other people to invest into them that have got a different approach to market. And what we've seen through that accelerator, and it really gives me great pleasure when I see this and pride, that we see 3 or 4 space-focused funds clubbing together to invest into those companies that have come through our accelerator program. That's fantastic because they've just taken a different thesis on the market, and that's great. So this is the reason why we've got a growth fund. So when I'm speaking about this to the LPs and investors that are coming into our growth funds, I can say, look, we're not investing into the moon or Mars or space travel right now, but we're building up a whole range of companies through our accelerator program where we're building knowledge and relationships with the teams, where we can revisit them every quarter as to when is the right time to invest into some of these. And my belief right now as to where we're sort of standing right now is I'm happier to do that in the C series than I am in the seed and Series A and Series B today as to where we stand today. Show me a fantastic moon company in C series, and I'm super interested. So that's really how it sort of works for us right now. But that evolves over time and with the market. But everything comes back to wanting to make a return over a time frame that matters to our investors, and that really defines what we're investing into.
When do you think we'll see the first British astronaut on the moon?
On the moon. Wow. I was disappointed to see that out of all of the various European nations contributing to the European Space Agency's, recent round of funding, that UK was one of the few countries that, that took a step backwards rather than a step forward. So, I think that we're in the wrong. Do you know what? I just don't know. I don't have an answer to that question. I don't. I would love to see Tim Peake flying the flag there sooner rather than later, but I just don't. I don't know the answer to that. I couldn't even herald a guess.
No, I trapped you with that question, so I feel for you. Mark, what do you do for fun?
What do I do for fun? I find my day job fun. So that's the first point.
That answer doesn't count. Every time I ask that question, 90% of people just say that.
So look, so I love anything that revolves around the sea and being on water. I love everything to do from scuba diving right the way through to wakeboarding and everything in between. So anything to do with boats is my thing. So that's the thing that I sort of work hard for, so that I can take a sort of European length holiday and enjoy the water sports. So that's my thing. But being with my family, I've got 2 kids that are just starting university and at that sort of age. So they're now at a sort of an age where I can do a lot of fun things with them as well.
Yeah, that's amazing. Well, Mark, thanks so much for being with us. This is a great conversation. I feel like we could have easily talked for hours longer. So thanks so much for all your context, and congrats on all the success so far.
Thank you. And, I think that we're only scratching the surface. I genuinely do. We're right. To go back to where we started, we are really at the beginning of the growth inflection point for this market. Space tech has become a permanent institutional allocation as far as I'm concerned, which really then creates a capital floor for the sector that's never existed before. So this is the reason why I think we're on the first rung of the ladder. So thank you for having me on the show, Mo. I'd love to come back in the future and share some more thoughts.
Absolutely. Until next time, Mark.